Hey, what's up guys? Market has been down for the past few days. Could this mean that another bear market is here? In this video I will explain why I'm not buying any assets right now but waiting for another market crash. I know that you should not try to time the market, and this is not what I'm doing. I'm not trying to predict where the market is going to go next. What I'm doing is I'm trying to position myself based on the current market evaluations. We know that the economy is in deep shit currently, but the stock market skyrocketed recently. Here are two very important indicators that can help you to position yourself in any given time in the market. First one is my favorite. That is Warren Buffett indicator. I spoke about this indicator a few times in my channel previously. Basically what it does, it compares the entire market cap of US publicly traded stocks to GDP. This is a long-term valuation indicator that has become popular in the recent years, thanks to Warren Buffett. Back in 2001, he remarked in a Fortune magazine interview that it is probably the best single measure of where valuations stand at any given moment. The Wilshire 5000 full cap price index represents the entire public stock market in the United States, and currently the total market cap of this entire stock market is at around $31 trillion. This is how much you would have to pay if you would like to buy every single company in Wilshire 5000. On the flip side, we have a representation of our economy in terms of GDP. As we can see, that GDP has a steady growth without much of volatility. It typically grows between 2 to 4% a year. During the recession, it drops in the 2 consecutive quarters or even more. The current GDP is at around $21 trillion. This included the negative 5% growth in the first quarter of 2020. As we can see from this chart, the green line represents GDP level and currently it's slightly tilted down. Similar scenario we had seen during 2008 housing bubble when GDP level dropped as well. To calculate current market cap to GDP ratio, we simply take $31 trillion of the market cap and divide that number by 21 trillion of the current GDP, and we get 1.47. We take that number, multiply by 100, and we get 147%. What it means is that the entire stock market is 147% higher than the current economy. This is crazy. We have never seen such a high evaluations in the history. In 2000 dot-com bubble at the peak, this ratio was at around 140%, while in 2008 housing bubble, this ratio was slightly over 100%. If you look at this table, it represents how undervalued or overvalued the market is. Right now we are at 147%. That is significantly overvalued. The fair value is in between 75 to 90%, and the market is undervalued when the ratio is way below those numbers. At the bottom of the dot-com bubble in 2002, the ratio dropped to 70%, which was slightly undervalued. It was a good time to buy stocks. At the bottom of the housing bubble in 2009, the ratio dropped to 50%, which was significantly undervalued. This was the best time to buy stocks in the past 2 decades. Buffett said during that time, "I feel like an oversexed man in a harem. This is the time to start investing." But is right now the time to start investing? This is not what Warren Buffett is doing, and this is not what I'm going to do. The second and also very important indicator that you should keep your eye on is Shiller PE ratio. This is very similar to the simple price to earning ratio, but instead of taking only 1 year, Shiller PE takes the entire decade and allows you to see where we stand at any given cycle. Currently, Shiller PE ratio is at 29. If you look at this chart, even Child would say that the market is overvalued. The only 2 times it was higher is during 1929 Great Depression. At that time, Shiller PE was at 30, and in 2000's dot-com bubble, Shiller PE was at 45, and we all know exactly what happened after both of those cases. The mean is at around 16. This is the fair value. If it's over 16, it's overvalued, and if it's under 16, it's undervalued. In 2009, when housing bubble popped, the ratio dropped to 15, which was another good indication that it was probably a good time to invest again. Theoretically, it looks very simple. If you buy when market evaluation is fair or undervalued and sell when evaluation is highly overvalued, you will make money. But in practice, it's much harder to do. At every peak of the market, people will find new reasons why market will continue to go up and why this time is different. And during the recession, they will find new reasons why market will continue to go down. You do not have to find your emotions so much when you look at those simple metrics. Now, let's take a look what Anthony Pompliano has to say about our current economy and the stock market.
What the heck is going on in the economy? Why the stock market is going up, but the economic data is getting worse? The big news is the economy is not getting better. Duh. People are still sitting at home. They're not out doing any sort of real economic activity. Most restaurants are still closed to dining in. Most stores are still closed to people coming in. If you are under a government mandated shutdown, it's nearly impossible to have economic activity. The government is preventing economic activity for good reason. We need to make sure that people are safe, right? We need to be intelligent about how we reopen the economy. We can get to that in a second as to how that's going. But ultimately, the idea that we are going to see some massive recovery just makes no sense, right? You can't have a recovery while people are still sitting at home. And so if you look at the places that are reopening, it looks like there is a continued spread in many places. I think in Florida and other states, we're actually seeing new highs in terms of the amount of hospitalizations, infections, etc. And so I tweeted earlier, Apple opened a number of stores in various states that they're now closing. So they reopened the stores, now they're closing them. We then saw the cruise lines today announce that although they had restarted all of the cruises or some portion of the cruises, they are actually going to refrain from any cruises until September, I think it was. You even see things like the airlines saying we're not going to serve alcohol anymore because we are trying to do social distancing, etc. So although everyone is excited about the reopening of the economy, you aren't seeing a major recovery in the underlying economic data around GDP, unemployment, and other things. And two, you are also seeing signs that we are likely to be headed into another shelter-in-place order. And what ends up happening is people are going to start questioning, should they actually go shelter in place? The social construct of you only can tell people to do this so many times. And so by reopening the economy and trying to get some sort of economic activity going, it's such a black and white thing. They either say, come out or go home, come out or go home. What is likely to end up being the correct solution, in my personal opinion, is that we are going to have some nuance. You're going to have to say, if you are old, if you have a pre-existing health condition, do not come out. Stay home, shelter in place. We will do everything we possibly can to protect you. We will put government resources and private resources to protect you. But if you are not old or have a pre-existing condition, you can come out. We would like you to come out. Please wear a mask. Please keep social distancing. Please wash your hands. Please follow all the capacity guidelines in restaurants, bars, stores, etc. But we are going to have some nuance because it is nearly impossible for the U.S. economy to continue for, let's say, the rest of this year. Imagine if we went from about March 15th until the end of the year under a shelter-in-place order. It would decimate the U.S. economy for years and years to come. And so what I think we're going to have to do is we're going to have to find some nuance. Now that brings me to why the hell are stocks exploding and economic data continues to get worse, right? Just yesterday, we saw another 1-point-something million people file for first-time unemployment benefits. That means almost 45 million people out of 155 million in the U.S. workforce have filed for first-time unemployment claims in the last 90 days, give or take. Think about that. 1/3, almost 1/3 of every person in the US workforce has filed for first-time unemployment insurance in the last 90 days. So why are stocks going up? We saw a 4.8% decrease in GDP in Q1. Q2 is likely to be further down. It's because, one, people saw the end of a timeline, or they saw kind of light at the end of the tunnel, that there was going to be a reopening of the economy. And so if your business has dropped 99%, like the movie theater industry, or American Airlines reported 90% drop in revenue, if you've already dropped 90, 95, 99%, any economic activity will lead to a recovery. It will look positive, right? Because you already are desensitized to the numbers. You've already dropped so much. And so people are speculating on, well, if the economy reopens, there's going to be a restart of economic activity. And if there's a restart of economic activity, then obviously there'll be revenue, and then you'll get this appreciation. Now, this is really, really important data point. Even though stocks in many cases had dropped 35, 40%, in some cases 80%, that does not mean that they are now better priced. So if you take an example, and I've talked about this before, United Airlines stock. If United went from $80 down to $20, it seems like, oh, that's really cheap. Literally, the market cap of the company was less than their 2019 revenue. Seems like it's undervalued. But is it? No, because that revenue dropped 80, 90%. And so even though the stock had dropped 70 to 80%, it was still overvalued given the financials that it was posting. And so now the speculation starts. When are we going to reopen? How quickly will the economy recover? Data that we are seeing early, and also seeing Apple close, cruises close, Major League Baseball start to send some people home, right? Seeing all of these things suggest that that economic recovery is not going to happen. And also when you add in the social pressure, you're going to start to see that people are going to be considered irresponsible for having their stores open, for the restaurants being open, right? And so you've had this dislocation in the market between the stock market and the economic data. The second driving force, other than just speculation of the economy reopening, ends up being that the Federal Reserve is pumping asset prices to the moon. They're just pumping asset prices. Why? If you remember, back in March and into April, there was a liquidity crisis. What happens during a liquidity crisis? Everyone looks around and says, there's uncertainty, there's chaos, and there's fear. I want cash. I want US dollars because that gives me the most optionality possible. And they look around their portfolio and they sell every single asset that has a liquid market attached to it. Stocks, sell them. Bonds, sell them. Gold, sell it. Bitcoin, sell it. Anything that I can sell and get cash. And so in that liquidity crisis, the dollar strengthens and asset prices all fall. Everyone's just selling at whatever price they can. And so all other assets other than the dollar, the correlation moves towards one. That's what we saw in March and into April. Everything went down. Stocks went down 30%. Bitcoin went down 50%. Gold went down 15%, right? Everything went down. Well, the Fed steps in and says, wait a second, we've seen this play before. In 2008 and 2009, we saw assets go towards a correlation of one. Gold, for example, over the summer of 2008 went down 30%. What can we do? What's in the central bank toolbox? We have two tools. One, we can manipulate interest rates. They did 2 emergency rate cuts, and they cut rates to 0. It's as low as they're going to go. There's a religious aspect of going from below 0. Right? I do not think they're going to go to negative rate territory. Hopefully, I am correct on that, but we will see. The second tool they have is they can print money or create money, quantitative easing. And so they've done that to the tune of trillions of dollars over the last 90 days. The Federal Reserve's balance sheet has expanded by almost 75% this year. If they end up putting through the $1 trillion infrastructure plan that is rumored to be being currently worked on by the administration, that will end up being over 100% growth in the Federal Reserve's balance sheet in a matter of months. It will have doubled its balance sheet in a matter of months. Those are the only tools they have. They can cut interest rates or they can print money. They're doing both of them aggressively.
I agreed with Pump that economy right now is in worse shape than it was back in March. Number of cases continue to increase, and it looks like we might see a second wave of this illness. If this is true, we might also see a third quarter or even fourth quarter of negative growth in GDP. Stock market always goes in cycles because humans are involved with their emotions. I see no reasons why market would not decline to its GDP level at least. And when it does, it will provide another good buying opportunity. Let me know what do you guys think about our current market and the economy. Leave your thoughts in the comment section below, hit that like button and subscribe if you haven't.